welcome everybody. It's Wednesday. It's Wednesday, 9 o'clock. So we're coming to you all live, talking to you from Invest in Education Academy. So clearly Facebook has changed some things up. So we are adjusting to the change up with going live. So we might have some technical hiccups here and there. Just work with us. So one of our members kind of called and said, you all talk about like winning stocks quite often. What about stocks that aren't performing well? And have you all basically picked stocks that aren't performing well? Yes, we have. We've told you that many a time. You really can't be in the investing world and not pick an underperforming stock at some point. So we're going to talk about that today. We're going to kind of air out our dirty laundry. But with that being said, I'm going to let Leon tell you why we chose this topic and what it should really mean to you all while I do a little bit of housekeeping. And if something goes wrong, just bear with us because the platform is definitely different.
Yeah, so it's funny. So shout out to IEA member Yao, who brought this to our attention last week. And it was actually funny because Brent and I had a conversation, I think like a week before. We were saying how we kind of wanted to, because basically, so the way it works is on the IEA platform, inside the membership, we keep a running list of all the stocks that we pick. So certain members can see all the stocks and certain members can see just the weekly stocks. And we have an update. We have an update since we started on April 1st, 2020. It's been running since then. So a question to one of our members was, we talk about our wins, but we seldom talk about our losses. And that's true. He's right. We hadn't actually pointed out any of our losses. We always say we definitely have losses for sure. In this game, you cannot be in this game without having losses. And if we had no losses, our returns would be up in near the 90s or hundreds. And as we've always said, our returns since April 1st of last year are in the mid 40s. We're about, well, we'll get to that in a minute what the actual number is, but we'll share with numbers. But we're well above the average of the market, which is 10%. So what we want to do today was actually show you our losers. I mean, I don't know many people out here that are willing to show you their losers, show you how bad the losses are. But we are. We always said full transparency. We've always said before, we do have losses, but now we're going to actually show you our losses. All right. You got anything, Brent?
Yeah, well, with that too, you've got to think this shouldn't make you run from the market. And just because you have losses, and this goes back to doing your research and making sure you're investing risk capital. When you're doing those two things, the losses don't hurt as bad because number one, you're not betting everything that you have on it. And two, the emotion is kind of removed because if you know why you're investing, what your goal with investing is, and your entry point, exit points, how long you're going to stay in the stock, some of the emotion that comes with these, underperforming stocks isn't as disruptive to you emotionally as it could be if you tried to, bet the mortgage because you just knew it was a guaranteed win. That's when you take the stock market into more of a realm of gambling. And that is not what we preach here at Invest in Education Academy. We really have a buy whole strategy. You want to look at least like 5 years. Extreme minimum, I would say like 3. And anything below that, you're moving into a trading type of mentality with the stock market versus investing.
Yeah. And like I said, we always said before, we definitely have losses. Losses in the stock market. There's no business where you're going to win every time, right? There's no business where you're going to win 100% of the time. Doesn't exist. And if you believe that there is a business like that, you're being lied to. Like there's always a cost of doing business. And in the stock market, I mean, really, since commissions have been removed from stock trading now, the only real cost of doing business are we're not going to say the term losses. These are what they call drawdowns. A loss is only recognized when you sell the position. We have in our positions, a lot of these we have not sold out of. We may still hold, or we may not have actually bought. We just may at the time say, okay, this was a good stock, so we want to bring it to you all's attention. But I'm going to change the term loss to drawdown because drawdown is just a term that means the stock is down in the portfolio, but you haven't recognized the loss yet. Yeah. So go ahead.
Yeah, and it's just considered like when people say, oh, I lost so much money today. If you did not sell the stock, it was considered an unrealized loss. And if you are like, oh, I made so much in the stock market today, but you haven't sold the stock, you haven't actually realized that gain. So that is an unrealized gain. So you really need to know the difference between a real loss and an unrealized loss, and or real gain or unrealized gain. It doesn't occur until sales made, which, it's important just to understand where you are.
Yeah, and like I said, you're always going to have losses in the market, as you see from looking at. So what we have on the screen here is a slide with for the stocks. We have more losses than just 4. But we just took a sample. We do. So we have 4 from here. But we have on the screen a card with 4 stocks where we have losses. And like I said before, drawdowns, not losses, drawdowns, because we have now recognized the loss yet. And remember, as I told y'all before in a previous live, I had a stock that was down 50, 60% in, but because it was a small percentage of my portfolio, I was able to ride that loss out. And I think I ended up gaining over 50% on the stock over the next, it was over like a year period. So drawdowns are not a bad thing. I mean, they're going to happen. No, you're never going to win 100% of the times. And you only recognize that actual loss when you sell the stock. If the story around the stock hasn't changed, the fundamentals haven't really changed, maybe the market's down, maybe the sector's down, maybe that stock had a bad quarter, what have you. But if you believe in the stock long term, like Brent said, we look at minimum really 5, but really minimum 3, but it really should be 5. But minimum 3 years. But if you're looking out that long and you have a down, say quarter, stock is a down quarter, down a couple months, it's no big deal because we know we're holding for at least 3 to 5 years. So what we're seeing, so we have on the screen right here is 4 stocks, right? We have C3.ai, Aurora Cannabis, Lee Auto, and Huya. And I'm just going to go through all 4 and just kind of give you. Now, remember, we don't know why a stock is down. We can only speculate why a stock is down, because when you buy a stock, you have no idea what it's going to do. So our whole thing is just buy quality companies and hold them until you get a return. So for whatever reason, through today, C3.ai that we picked a few months ago is down 53%. Big number. I think that's one of our biggest losses. Sorry, one of our biggest drawdowns we have from the stocks we've picked over the last year. And so the theory behind why C3.ai and a lot of the tech company, especially a lot of these SPACs and a lot of these IPOs that came out late last year into this year. So one of the big reasons, the theory behind why they're down is because interest rates, right? And when interest rates rise, the stock market then has competition, right? And when you're looking at tech stocks, their earnings are they're typically based on future earnings, right? So it's like, with tech stocks, their PE ratio is going to be really high because the expected growth in the future is really high. Well, what happens when interest rates rise, people say, well, do I want to wait, another 2, 3, 4 years for these big returns to come in? Or do I want to take my $500 million and go buy a treasury at 1.5 or 2%? Big money, a lot of big money said they'll take, because the interest rates got up on the 10-year, got up to about 1.7%. So a lot of money moved out of these really speculative new IPO, high PE tech stocks, and a lot of that went into treasuries. So a lot of these high flyer tech stocks got crushed, and C3.ai was one. It's down 53% through today. Mm-hmm.
Yeah, and also for anybody that doesn't understand how institutional money works, institutional money are, the Morgan Stanleys or the mutual funds that invest in the market, or you may have hedge fund managers. Many of them, their objective is really not to make their clients a ridiculous amount of money. It's not to lose. So the second they can get to a place where they're just getting 1% guaranteed minimum risk, they're gone. Like, that's what they're going to do. And actually, they're getting a lot of heat right now. Hedge fund managers are catching a lot of heat because they're actually, it's been proven that they're not trying to outperform the market. They're just trying to make sure there's no loss so they can continue getting commissioned. Some of the management is starting to push back, and also some of the investors are starting to push back, because in this environment, people are moving towards what's called robo investing, but that's a whole nother thing. Just hedge funds or institutional money in general, they want guarantees. They don't want risk. And when there was no other option, like Leon said, they had to go to the market. As soon as the rates start to go back up, it became, a competition between really standardized investing or traditional ways of investing, safer ways of investing, and looking at the stock market as a hedge.
Yep. Yeah. So, but yeah, before rates. So when COVID hit and the Fed dropped rates to 0, There was no. So the term is called TINA, TINA. There is no alternative. So we were in this TINA environment where there was no alternative. You had to do the stock market, or you were sitting in cash. And of course, sitting in cash, you're losing money every day because of inflation. So these big funds had to take those billions of dollars, just poured into stocks, because stocks was the only game in town where you can get any sort of yield. So, but now the rates have come off of zero and are now pushing up around between 1.5 and 1.7%. Like Brent said, big money's like, if you're sitting on $500 million to tens of billions of dollars, 1.7% is a really good return. So and essentially with no risk, because again, treasuries are backed by the federal government, so there's really no risk of loss. So that's what's happened to these really, really risky tech stocks. They've taken a huge hit. Does not mean they're bad companies. Doesn't mean they're uninvestable. It just means the level at which we got in was high, right? We bought at the time, it looked great. Now it's not, right? So, but again, we size our positions properly. We know we're holding for at least 3 to 5 years. No big deal. Being now 53% in C3.ai, to us, no big deal. Second one is Aurora Cannabis, ticker symbol ACB. That one through today was down 34%. One of the reasons why, well, again, speculating, one of the reasons why is that, these fall into the high PE, the high valuation stocks. Again, big money said, hey, I can go be in a lot safer position in treasuries. Let me do that, move out of some of these cannabis stocks. Cannabis has had a serious run in the last year. I mean, they're up. Cannabis stocks are up, I think, over 100%. But recently, just like tech stocks, they've kind of bumped up against a ceiling and they're kind of going sideways. So cannabis is also getting hit. The industry is also getting hit by the interest rates rising and a lot of big money moving out of, again, speculative cannabis stocks, like some speculative tech stocks, into safer investments. Next one is Li Auto. This one is an EV in the likes of Tesla or Xpeng. Again, similar theme. And so if you notice, the stocks that Brent and I picked, at least these four here, not all of them, but are a lot of them they're high volatility, high-ish volatility, and they have high valuations. That's because, again, higher valuations, the market's saying they expect higher growth. So we're looking for higher growth. We're in the game. We're going to be in the game for these next 20, 30 years. So we're not trying to sit on anything that's only going to pay 1%. We want high growth. With high growth comes, higher risk. But again, we know that going in, we size our positions appropriately, that, these drawdowns do not affect our account, greatly. So Li Auto is kind of in the same boat. It was a high valuation stock. Again, got hit by money moving out of high valuation stocks and into treasuries. And Brent, I'm not familiar with Huya. I think you picked it out.
They're in the gaming platform in China. But one of the things about all these stocks is they fall into the speculative spectrum of investing. And when you look at speculative stocks, the goal is that you're speculating that it's going to have a certain rate of return into the future. The stock market as a whole is always forward facing. And this is one of those moments where I'm going to say, when interest rates rose, I feel like the stock market looked back in time for a hot minute and had a moment where it said, what were we doing? All these valuations were highly, the signs were on the wall, these companies are overvalued. But that's also had been the nature of the market for so long, nobody cared. And when interest rates rose, it was as if the market itself just said, wait. Why did we move so far away from what is a more systemized way of looking at investing? Like getting PE ratios that are reasonable, looking at the market segment and saying, okay, in this particular sector, what is extreme and what isn't? It was just new IPO, let's invest. And so all these are speculative, but they're also speculative in a really good industry. So AI, when you're looking at data, big data is going to be everything. C3 AI. And I like it. The cannabis industry, it's a lot of competition out there. And also they still face what's called governmental risk. And the governmental risk is on the tax side for them. And then you have Li Auto with the EV market. It's one of the hottest markets. And I don't think you can find too many EV car companies that don't have a high valuation. And I think in the long run, they're going to be fine. And Huya, in the gaming space, that's the future. When we look at what's happening with crypto and gaming and crypto and fashion in general, all these worlds are falling into one another. And it's going to be a moment where we look back on this day and you're going to be like, wow, you know what? I looked at that thinking maybe these are on sale. You know, maybe you're looking at this thinking I'll never buy any of these stocks ever in my life. And I can tell you now, I've put more money into C3.ai, and I also put more money into Lee Auto. Full disclosure, do your own research. We are not endorsing this for anyone out there. We're not saying this is a great investment for somebody who's just watching going, oh, I'll never touch those. And you're interpreting what we're saying as a buy signal. It's not. You always have to do your research. And Leon said this a million times. Make sure your size of your investments is portioned in a way that allows these bumps in the road, and that's what I want to call them, to not hurt your portfolio overall. And that's why we said why losing stocks don't always hurt a portfolio. Because if you look at the bottom bullet, over the last 12 months, we've picked roughly 107 stocks, and our average return is still 45.76%. 45.76%. That the market itself returns 10% per year on average. So we're still 35% over the market. So, I mean, you really have to look at and this is including these down and more. Like Leon said, there are others.
Yeah, there's more down ones. Yeah, but yeah.
But, you know, go back to what we always say. When was the last time you checked your savings account? Or when was the last time you checked to see what the money under your bed was doing? I'm pretty sure it's not making you 45% rate of return. And granted, 2020, I think we all will agree, we don't think in the stock market 2021 is going to be the same, but 2020 was definitely an anomaly. And I do think we're going to see some more anomalies, and I think we're going to see some corrections going on. And the market needed this pullback. And so,
I mean, think about it. You're looking at the screen here or listening to the podcast. We have stocks that are down 53%, 34%, 36%, 21%, and there are more that maybe aren't down as much, but are also down. All that being said, we're still up on average 45.76%. Now, what that means is that we've picked more winners than losers. But that's not by accident, right? We do our homework. We study sectors, we study industries, we study particular stocks, we study their fundamentals. So there's a reason why we're still up 45.76%. But that doesn't mean we don't have losers. We definitely have losers, but our winners far outpace our losers. And that, again, is, as we say, we do our research. Research is very, very important when investing in the market.
Yep. And so for anybody who's watching this, we know we're about to bring you our 2 stock picks for the day. But we wanted to take this moment to, number one, thank you all for sending us these direct DMs and saying, you know what, why don't you talk about this? Or texting Leon or texting myself saying, I haven't seen you all do this. Well, this goes to show we will put it out there, full transparency. Yep. This is the other side of our portfolio, and it's the much, much, much smaller side of our portfolio, but it does exist. And so for any of you all who are new to the market and you're seeing this and thinking, oh my gosh, that's the reason why I don't want to invest, this is when diversification really comes into play. You have to be not only stock diversified, but sector diversified when you're picking a portfolio. It's hugely important. Also, just from an overall investing, because Investing Education Academy, we talk about overall investing all the time. This is that moment, again, where you want to have your stock portfolio, but maybe you have a real estate portfolio, or maybe you collect fine china. I don't know. Either way, there are other ways to invest and balance out a portfolio for diversification that sometimes doesn't even include stocks. It's not the only way to diversify. So just think about this, and still that 45.76 still feels pretty good. So
yeah,
we wanted you all to see it, but yeah. For other than that, Leon, if you have anything, I can jump into the picks for today.
No, just again, we'll drive this point home. When you invest in the market, you will have drawdowns. You will have stocks that do not perform well. If you're in the market for the long term, they're quality companies. They should come back. And don't expect every stock you buy to be a winner. As we just showed, we have losers. There was only 4. We have more than that. But what mattered was that last bullet. Overall, our portfolio, this podcast portfolio is up 45.76% over the last 12 months. That the bottom line. That's all that really matters.
Yeah, and let me see. For anybody who's looking at also a balanced portfolio, like I said, it doesn't always have to be just stocks. The IEA Crypto Bulls has been in, like I'll say, beta for about 2 weeks now, maybe. And we'll probably be doing our full launch. May 1st definitely seems in reach. So we have a May 1st goal to launch IEA Crypto Bulls. We have been doing really interesting things in the cryptocurrency space, NFTs, learning the differences between the exchanges, cold storage, wallets, swaps. It's quite interesting, and it's great learning something new. So if you are interested in becoming an IEA Crypto Bull, please direct message Leon or myself. As we have said many times, for the first group who become bulls, you'll be going into Leon and I's group, and it's gonna tap out somewhere. We're gonna max out somewhere between 20 and 30 people. When we get to 20, we're gonna stop and just see how noisy it is. And the way we're gonna do it is every 20 to 30 people, we're gonna close that group and then open another group. When that group closes, the next group's price point will either be doubled or half, 1.5 times what the original group was. So if you're interested, I would suggest it's $200 a month that you contact us now, because we haven't even launched fully and we have 12 people or more already in our beta. So we're going to probably hit that 20, 30 mark pretty quick. And we're going to, the information we've learned, we've already made thousands of dollars just from the information that we've gained. Actually, last week we made thousands from this is great. So exciting. But from the information that we've gotten from the group chat, and we have meetings coming up with people who are doing deals in China. We have, and they're all in the chat. We have a thing with NFTs that we're not even going to talk about too much, but IEA is getting into the NFT market space in a way you probably didn't think we would do. So it's just a lot of good stuff coming on the horizon. And if you want to get involved in the IEA Crypto Bulls, you can send Leon or myself a direct message. Do not wait. As it is now, we only have 8 slots before we hit 20. And if we decide to go to 30, then it'll still only be an additional 10 more slots. So yes, please let us know sooner than later. All right.
And just one last one that is that just so everybody knows, there are way more cryptocurrencies than just Bitcoin or Ethereum. Like, we're learning about new coins every day. We've made investments in coins in the last month that are up. I have one that was up 100. I have one that was, I've been in a month, only a month. Now, I didn't put a lot of money into it because, again, just trying things out, see how things work. But I'm up 116% in about 3 weeks.
Yep.
Is that sustainable? Who knows? But I'm still up 116%. Now, I think it is because I've done research behind the coin and the technology that it's based on. So I do think this is early days for this particular tech project. But yeah, like I said, if you want to join Crypto Bulls, great. If you just want to do the research on your own, great. But just do your research into crypto, because it is a freight train coming down. And like I said, here at IEA, we're looking to ride that bad boy all the way to the top.
Yeah, in the last month, last week alone, I probably made enough to pay my car note for five months. Last week, in crypto alone, I made enough to pay off my car, but I'm not going to do it because I can keep making more money. So, and the interest rate on the car does not come close to what I'm making in investing, and those are strategies you need to know about. But that's a whole nother thing. Yeah, this is quite exciting times. Quite exciting time. So, all right, with that being said, going back to energy, I'm in this space fully. Energy, gaming, it's just fascinating to me right now. And I'm more and more, I'm becoming very interested in luxury goods, but that's another conversation too. So I chose Bloom Energy Corporation. Ticker symbol is BE. For anybody listening to us via the podcast, Bloom Energy is on a New York Stock Exchange. It's trading under ticker symbol BE. And as of yesterday's close, which was the 20th, it was trading at 20, well, actually today, let's close the business today, the 21st, it's closing at $23.74. So I really like Bloom Energy because, again, anything in the energy space is very intriguing to me. Now, let me say this. For anybody, especially those who are kind of checking out some of the picks I personally have been making over the last 2-3 months, you have to realize I'm in a space where I'm enjoying speculative investing. And that is a very risky type of investing. And I don't know, these companies don't even have a long history to look at a 5-year average on them. It doesn't exist. And so I'm basing this off of what the company's doing, where the industry and sector's headed, and the need of that it could possibly meet. If any business can't meet the demand, especially in this day and age, of at least like 100 million people, I think it has a limited life, period. So if any company, if it can touch 100 million people or more, or somewhere close to that space, I'm giving it more consideration than I would anything else. Bloom Energy, for the most part, let me give you a quick read up on it. They design, manufactures, and sell solid oxidized fuel cell systems for on-site power generation in the United States, Japan, China, India, and the Republic of Korea. I'm gonna stop right there. So when they're producing power for, and I'm gonna take the United States out of it because the United States is small, but you say China and India, you can stop there. The amount of people they can service goes well beyond 100 million. And that's what I'm really looking at, like how many people will have a need for this technology, even if it's done as a pass-through with a bigger established corporation. So mainly they provide power to like hospitals and large-scale institutions, like big buildings, big, large corporate entities. And so those individuals are going to then service hundreds of thousands of people in any like given month or year. So over the long run, they're going to have a huge pool of potential clients to service or to deliver fuel to. And right now we're looking at this clean energy. When you talk about Japan, I'll throw Japan back in it. Japan's commitment to clean energy is so extreme right now. They're saying, I think by the year 2027, 28, at least by 2030, they want to have all cars in Japan are either electric vehicles or some type of clean burning fuel car. That's huge. They're talking about all of Japan. And when they have a commitment like that, they're going to have to do what? They're going to have to spend money to get these companies in place to provide energy for that that infrastructure, which is what's happening in the US also right now. Our governments are starting to put a large amount of money into infrastructure building and supporting for electric vehicles or clean energy. So these trends aren't going anywhere. I like the company really just for that reason. And yeah, that's my pick for today, Bloom Energy.
Yeah, can't go wrong with alternative energy, especially with the way the world's going, and then even with the Biden infrastructure plan coming. A lot of it's based on green energy too. All right, so my pick is Community Health Trust, ticker symbol CHCT. I'm just going to read you about what they do. So they own or finance real estate properties that are leased to hospitals, doctors, healthcare systems, or healthcare service providers located in geographic areas, primarily outside of urban centers. So kind of more the suburbs is their target. They go on to say, as a result of favorable demographics, which is generally basically means that the graying of America, like the baby boomers, the health demographics affecting the healthcare industry, continuing increases in healthcare spending, and the continuing shift in delivery of healthcare services to community-based outpatient facilities, we believe our properties are essential for healthcare providers to serve their local markets. So essentially, yeah, they're servicing one of the biggest industries in the United States, which is essentially taking care of the baby boomers. And now that we have COVID to deal with too, that just more amplifies the need for healthcare centers, healthcare services, healthcare offices, and the like. So that's what they do. Now it goes from their financials, which are pretty good. So over the last 3 years, they've been growing their revenues at 26% on average per year, and they've been growing their profits 92% on average per year. So man, that's over the last 3 years. That's just that includes 2020, which probably for them was probably a boom year because of COVID. These centers were probably full. But even outside that, the 2 years prior to that, they were doing well too. So again, average profit growth rate 92%, revenue growth rate on average 26%, and the kicker is they pay a 3.37% dividend. Again, 3.37% dividend on top of the great earnings, the great revenue. So no matter what the stock does, you're going to earn at least 3.37%. If the stock was just stay flat, if it goes up, that 3.37% will be added to your profits. And if it goes down, that 3.37% will help cushion your losses. So my pick is Community Health Trust, ticker symbol CHCT.
Yeah, healthcare is huge right now. It was, I think, estimated being like $16 trillion industry. So yeah, this is awesome. So anyway, everybody, look, this advice we're giving is only intended for entertainment purposes only. You still have to do your research. It is our thoughts. It's not yours. You have to make sure the stocks we pick make sense for your portfolio, and make sure you do your homework. Spend some time with it. See if it fits into your asset allocation that you currently have. But overall, get into the market, get into some type of investing that makes sense for you. Because if you just sit and watch, the economy is getting faster and faster, and the rate at which people are becoming millionaires is actually becoming commonplace. It's not even like exciting anymore. So, what side will you be on when all of this quiets down? And at some point, all things level off. So, just remember that. We hope that you will join Invest in Education Academy if you're interested in becoming an IEA Crypto Bull. Send Leon a direct message, or you can send Brent Simpson, myself, a direct message, and we can talk about it. We have at least 8 slots left. We may have 10 more after that, but it just depends on how things go. So with that being said, thank you for being with us, and we will see you all later next week, again on Wednesday at 9 o'clock. All right, bye.